Hey everyone, my name is Jack, and in this video I want to go over what a debt-to-income ratio is and why it's important for real estate investing. Your debt-to-income ratio is just as it sounds. It takes your total monthly obligations and divides it by your total monthly income, resulting in a ratio number that lenders will use when they determine if you are approved for a loan or not. It's very similar to a sort of net worth number, only it's a little more specific in that it's based on your monthly income rather than your total amount of assets. Let's take a look at an example. Let's say you make $36,000 per year, which is approximately $3,000 per month. You currently have a $150 car payment, an $800 mortgage payment, and a $50 credit card payment to make each month. Your total monthly debt payments are thus $1,000. This means that your debt-to-income ratio is 33%, or 1,000 divided by 3,000. So why is your debt-to-income ratio important? Quite simply, it looks at your capacity for handling additional debt. Barring a miracle, if you had a 110% debt-to-income ratio, you are not going to be able to maintain that without either decreasing your debt payments or increasing your income. Most of the time, creditors will look at your debt-to-income or your DTI ratio pretty closely to make sure that you can handle taking on something like a mortgage or another big loan that they offer. While DTI is not a perfect measurement, it certainly is a pretty strong indicator to see whether you can handle additional debt. Knowing your DTI, just like knowing your net worth, is a very important financial measurement to make sure that you understand your capacity for taking on more debt, or for simply knowing how you can improve your situation for the future. Generally, the lower your DTI ratio, the more room for error you have, since you have less payments compared to your income. In a similar way, the higher your net worth, the more wiggle room you have in the event that things go south, since you can sell your assets to take care of your outstanding liabilities. When it comes to real estate, lenders are typically going to want to see that your DTI ratio is lower than 45%. Any mortgage that would put you above 45% DTI would likely be denied. Remember, lenders are taking a risk when they're lending money to you, even if it's on a piece of property. To mitigate this risk, lenders want to make sure that you can handle the debt payments comfortably without risking foreclosure. Hey everyone, before I move on, I just want to remind you that I have a free real estate metrics calculator in the description linked below. It allows you to quickly analyze real estate deals and even has a mortgage calculator built into it so you can figure out the exact monthly payments that you can expect on a property. Please take it off my hands, it's free. When it comes to real estate, if you're going to be using a loan in your own name and you want to take advantage of some of the conventional mortgage programs that have some of the lowest interest rates out there, be sure that your debt-to-income ratio would be below 45% after you take out the mortgage compared to your income. Thankfully, there's a way to increase your current debt-to-income ratio when you go to shop for a mortgage. This is especially true when you're buying a multifamily property or a property that you plan to rent out. Lenders will let you use usually up to 75% of the projected rental value of any units that you're not going to be living in. This is especially useful for house hackers, which I'll outline in an example now. Let's say you make $48,000 per year. That comes out to about $4,000 in pre-tax salary per month. You currently pay $200 per month in student loan payments, but you do not have any other debt. Your debt-to-income ratio before getting a mortgage is a measly 4.1%. Now let's say you've saved up a good chunk of cash and are looking for a property to buy. You want to house hack and you're looking for a multifamily building so you can use the rental income to offset some of your monthly expenses in the future. You find a 40-unit, a quadruplex that you really like listed for $500,000. You have enough money saved up to make a 20% down payment, so you'd need a $400,000 mortgage. At 4% interest over a 30-year term, that means your monthly payment would be $1,900 approximately. Add on projected taxes and insurance, and your total monthly mortgage payment would be about $2,100. If you were to take out a mortgage on those terms and add it to your monthly $200 student loan payments, you would have a DTI of 57.5%. That's much too high to meet the 45% requirement for the mortgage that you want to get. However, like I mentioned before, your lender allows you to calculate the projected income for the other three units into your monthly income for DTI purposes. Your lender projects that the other three units would rent for about $950 per month each. They're allowing you to add 80% of the rental value on those three units, meaning you can add an additional $2,280 onto your projected monthly income. When you put your actual income together with your lender's projection, you now have $6,280 in monthly income on paper. Now when you divide your $2,300 in projected monthly debt against your projected monthly income of $6,280, your DTI ratio drops down to a healthy 37%. And thus you're approved for the loan and you can start house hacking. The central lesson here is that buying income-producing properties allows you to bump up your debt-to-income ratio. The mortgage that might otherwise be out of reach suddenly is within range when you include the monthly rent of the units that you're not going to be living in, since you would theoretically and should rent them out. By increasing your DTI ratio, you'll be able to buy bigger income-producing properties that will allow you to get towards the path of building wealth in real estate. In conclusion, your DTI ratio is a very important financial metric that is paramount when you're investing in real estate, especially when you're using conventional loan programs that take your income into account. The lower your DTI ratio, the more attractive you are to lenders, since you have more room for more debt. Buying buildings with extra units that you're not going to live in, or buying income-producing properties, will allow you to increase your projected DTI for when the lender makes those calculations to approve you for the loan. This can allow you to buy bigger properties with higher income-producing potential. Your DTI is part of your whole financial picture, and you should always keep tabs on where it's at so that you know your capacity to take on extra debt. I hope this video helped you to understand how a debt-to-income ratio is important and how it works, and the steps that you can take to increase it when it comes to real estate investing. If you liked this video, be sure to give it a like, as it helps the channel out a lot. Be sure to subscribe as well if you haven't already, since I put out new content like this every single week. If you have any questions, be sure to leave comments below. Until next time, take care.